Comerica is proud to support the Ventura County Community Development Corporation's statewide 8th annual homeownership fair. I in particular am proud of this because I've been a Ventura County resident for the last 25 years. For the past 170 years, Comerica's success has been achieved by adhering to our principles through both good times and challenging times. At Comerica, our promise is to raise expectations of what a bank can be and reinvest in the communities that we serve. Through partners like the Ventura County Community Development Corporation, we can continue to deliver on that promise. During times like now, homeowners and renters are faced with uncertainty and adversity like never before. And resources like today's homeownership fair is one example of our community coming together to help those in need. I'm happy to introduce one of our very own Comerica colleagues, Alanush Avizian, Vice President, Banking Center Manager, to talk about home equity lines of credit. Alanush?
Hello, my name is Alanush Ayvazian. I'm the Banking Center Manager at Comerica Bank, West Hollywood location, and today I'm going to be talking about home equity lines of credit. In recent years, home equity line of credit became one of the popular bank products, yet many people are still unaware how they can use it to save money and add more value to their lives. So we will talk a little bit more in details about this bank product. Let's talk about the loan types. In general, loan types they can be categorized in two types, open-end and closed-end. Open-end loan is a pre-approved loan between lender and borrower that may be used repeatedly up to a certain limit and can be paid back prior to payments coming due. It gives borrower more control over when and how much they can borrow. Common open-end loans are credit cards, home equity lines of credit, personal and business lines of credit. As opposed to open-end, we have closed-end loan, which is a debt that is acquired for a particular purpose and a set amount of time. At the end of said period, the individual or business must pay the entirety of the loan, including any interest payments or maintenance fees. Common closed-end loans are residential and commercial mortgage loans, auto or boat loans, student loans, home equity loans, etc. Now let's talk about the different types of lines of credit. So lines of credit are, first of all, very popular type of open-end loans, which come in two formats, secured and unsecured. Secured line is secured by some sort of hard collateral, such as real estate, cash, marketable securities. Unsecured line is not. And this is where the difference comes. Secured line usually comes at a lower rate, and typically borrower can get approved for a higher line limit, whereas unsecured line, they can have higher rates or they are more difficult to obtain and require higher credit score. All right, let's move to the next slide. So as mentioned in the beginning of the presentation, one of the popular lines in recent years has been home equity line of credit, which in the banking world, we call it HELOC. HELOC is determined by equity in home. In a few slides, we will review how the equity is being calculated. For now, let's talk about a few of the features of this product. HELOC is capped at a certain percentage of combined loan to value, normally less than 100%. HELOC comes with a draw period, which is usually at 10 years, with repayment period, which is set by lender. Rates can be fixed or variable. HELOC has cost, but sometimes banks waive those fees to encourage borrower keep and utilize the line. Fees are associated with appraisal, title, credit report, line maintenance, etc. Now we're going to review the advantages of HELOC. So one of the main reasons that customers obtain HELOC is debt consolidation, which helps them reduce their monthly payments. We see rise in utilizing HELOC as a source of down payment in real estate transactions. Let's say, are you considering adding a pool, repairing roof, or reconstructing your garage? HELOC can provide funding to you. You can use HELOC to pay your or your kids' tuition. Are you past due on your business income taxes, which prevents you from applying for a certain business loan? You can use HELOC to pay those taxes. Sometimes business owners agree to use their own home as collateral to obtain HELOC and lend those funds to their own business. And last but not least, HELOC can be kept as rainy day funds, and it comes handy when you least expect the need. Let's see how HELOC can be useful during COVID-19. We noticed that HELOC has been a helpful tool during recent COVID-19 pandemic. whether it created safety net during this economic uncertainty, helped our clients during temporary loss of job to have access to cash, or it allowed our business customers manage their income reduction. They had temporary a temporary decrease in their income, so they were able to use the HELOC temporarily until their sales started to pick up. And eventually it created the peace of mind for the customers. Now let's review. We get a lot of customers who are asking us, what's the difference of refinance with cash out versus HELOC? Let's see what the difference is and how we should choose which one to go with. So here's where the difference comes. To decide which is the best move for you, you should consider how much equity you have available, what you will be using the money for, and how long you plan to stay in your home. If you wish to avoid high closing costs, you already have a pretty low rate on your first mortgage, and by refinancing, your rate will increase. You're unsure on when and how much you'll need to spend the funds on the desired project. Your need to access fund is temporary and you plan to pay it back in near future. It sounds to be a better idea to stick to HELOC idea. Also, sometimes some derogatory items on credit, such as bankruptcy, may delay the refinance by 7 years, whereas we allow clients to apply for HELOC even 4 years after the bankruptcy has been discharged and they've established great credit. So now let's see what are the few fun facts about Comerica HELOC. So we can take an application for an applicant that lives in another state. The application would default to collateral state to ensure proper documentation, rate, and fees. So as long as customers, the property that they need to use as collateral is located in our footprints, which is California, Michigan, Texas, Florida, and Arizona, no matter where they live, but they can use that property as a collateral for HELOC. We accept durable power of attorney who can sign the loan closing documents. We need to have the power of attorney documentation reviewed prior to closing. Power of attorney cannot apply on behalf of client, but at least that gives that convenience of signing the loan docs. We prefer to have a not black and white approach to our loan applications. In some cases, when application cannot be approved based on our underwriting policies and guidelines, we work with loan center and client for a relook process and potentially obtain approval. Common exception types are for low credit score, insufficient employment history, high debt to income ratio. So we can work with client to turn some of these decline decisions into approvals. We can offer margin as low as 0.25%, which is pretty low. Our HELOC range in California can go anywhere from $10,000 to $5 million. There's no limit on IRS taxes if the applicant can get us an accurate payoff. And for line requests up to and including $500,000, we waive the closing cost unless client is not satisfied with appraised value of property and they choose to pay to upgrade to full appraisal. Otherwise, they're going to pay $0 out of their pocket when they obtain the line. Applicants will have the interest-only payment option by default for the life of loan, which is 10 years. So if they they're not willing to pay the principal portion, they can stick to the interest-only payments. Now, in order to qualify for HELOC, a few factors are being taken into consideration, such as loan-to-value, debt-to-income ratio, and credit. We will talk about all of these separately. So let's start with combined loan-to-value. So combined loan-to-value is defined as a percentage of all loans secured by subject property, including HELOC, divided by the value of home. So I'm going to present two examples here, so you'll see that how we're calculating the loan-to-value. So let's assume that property is located in California and it's appraised at $800,000. Applicant has a first mortgage on home at $300,000. For this scenario, we may use up to 80% of home value to calculate the equity. So what we do is that to calculate equity, we take 80% of value of home, $800,000, minus $300,000 first mortgage. It comes at $340,000. So this is the equity that client can use to pull a home equity line of credit against it. At a second example, let's assume property again is located in California and it's appraised at $1.2 million. First mortgage is $950,000. For this scenario, we can use up to 75% of home value to calculate the equity. So 75% of 1.2 million minus 950,000 comes at negative 50,000. This means equity is negative. In other words, there's no equity for HELOC. Next comes the calculation of debt to income ratio. Let's see what's considered debt in our HELOC process. Unlike mortgage, where a lot of payments are added as monthly obligations, such as insurance payment or property tax, there's a much simpler approach in HELOC process. To put it in simple words, usually any debt that appears on your personal credit report is considered as your personal debt, regardless who makes the payment. With that being said, payments such as mortgage, car, credit cards are considered as debts. If you have any debt that you would wish to pay them off with HELOC proceeds, you can simply put them on the application and we will eliminate them from your debt calculation. So as you see, payments such as property tax, HOA monthly dues, insurance, and also those loans that client wants us to pay off with HELOC proceeds are eliminated from debt to income ratio calculation. For two reasons, I would get into the income verification phase now because number one, I'm not an underwriter. And number two, depending on type of income, we have different ways of verifying income, which might get a little complicated and confusing. So in our next slide, we're going to talk about what we need to verify income. Again, unlike mortgage, documentation list is much simpler. In 99% of cases, pay stub, W-2s, and personal federal tax returns are sufficient. Case by case, we may ask for further documents. Business tax returns might be requested if the line limit exceeds certain limit. Otherwise, we're not going to ask for business tax returns. We expect the self-employment and rental income to be reflected on personal tax returns. Therefore, we won't ask for bank statements, lease agreements, or 1099 to verify. Also, when it comes to capital gains, there should be consistency. So one-time capital gain is not counting towards the income. Okay, now that we have been able to identify debts and calculate income, let's review an example of calculating debt to income ratio. So let's assume client has requested a HELOC at 100,000. Let's say applicant has a monthly gross income of 10,000. And their debts are mortgage payment at 1,500 a month, car payment at 400, and credit card payments at 300. We also need to consider the HELOC qualifying payment, meaning that if client uses the entire line, what would be their payment, assuming that they would pay this during 20-year repayment, which comes after the 10-year draw period, which in this scenario, by the payment factor, but by the rate factor that we use, it comes at $863. So by adding mortgage, car payment, credit cards, and HELOC qualifying payments, debts come at $3,063. So debt to income ratio would be percentage of total debt of $3,063 divided by monthly gross income of $10,000, which comes at 30.63%. The golden number is 45%. As long as we don't exceed that, then boom, we are below 45% and ready to go. At the end of this presentation, I would like to also review a few conditions that may result in declining the loan. So low FICO scores, bankruptcy, loan modification, short sale and foreclosures discharged less than 4 years ago. Late payments and charged off amounts might cause loan to decline. Collateral type is very important, so that may determine if we can move forward with application. For instance, we don't allow HELOC on properties outside of our bank footprints, which again, I want to remind California, Texas, Florida, Arizona, and Michigan. So if property is in Nevada, unfortunately, we cannot offer HELOC on it. Also using investment property, co-ops, mixed use, 5 units and above, condo hotels, and properties currently for sale. These are properties that unfortunately we cannot offer HELOC on them. We would like to see HELOC in the first or second lien position. When in second lien position, it cannot go behind land contract, private mortgage, reverse mortgage, hardship modification, open HELOC with another institution, or behind a commercial loan. There is one exception here. If the commercial loan is with Comerica, we can allow HELOC to go in the second lien position. And also, real estate taxes that are due from over a year ago must be paid by customer before closing. Otherwise, bank won't allow for the process to continue. So we can only pay the real estate taxes of previous year only through HELOC, but anything before that must be paid by customer. So we can move forward with the process. Well, this concludes my presentation today about home equity line of credit, and I hope I've been able to add value to you. Thank you.